the fourth episode of Facts and Facts. This is the segment where I'm breaking down data insights when it comes to property investment, as well as respond to your frequently asked questions. In today's episode, I'm actually responding to a question by Shamal Pereira. He actually asked a question about, can you do a video about investing for Airbnb purposes? Very interesting timing about this question because it is something that we're talking about more and more. And funnily enough, our co-founder Peter was looking at doing this strategy in an area in Punchbowl, Sydney, which sounds like an area where it wouldn't do really well, but the numbers have stacked up and that's the approach that he's taking. And a lot of other investors out there are looking at doing strategies like this to help improve their cash flow, given that we're in an environment where rates are increasing. I do want to say one thing before I go ahead. It obviously depends on your strategy and what you're looking to do. I would very rarely look for investment purely for that purpose of cash flow. You also want to look at if the fundamentals are there for long-term growth as well. Because initially cash flow can look good in some areas, but if there's not the long-term fundamentals for growth, you want that property to grow in value, but you also want those rents and that cash flow to increase over time as well. And that's how the real money is made. So you want to balance what you're looking at in the short term with the cash flow with what you're looking at long term with the growth and growth of the income as well. Just a very quick recap on last week's episode, where some of these questions have come from is what's happening right now in certain areas. There's a bit of softening in the market, particularly in areas like Sydney and Melbourne. So what that actually means is that it's a really good time. It's a buyer's market, a good time to go out and get a deal. And what's happening in the future, you can see here using Victoria as an example, that there's a really sharp increase forecasted for immigrants to come into the country and migrants to come into the country. And this is being fast-tracked by the government to deal with other issues right now, like things in the labor force. But what's also happening is that supply levels are plummeting. Not a lot of new construction going on, and new construction in the future is at all-time lows. So what this is going to mean is there's going to be a real squeeze in terms of supply when counting the population that's coming in. We're already feeling it with the rents at the moment, with rents going up. And over the next 24, 36 months, we're going to start feeling the pressure on what this is going to do to prices. So now's the time to be hunting for a deal and then looking at what's happening long term and I guess where the smart money is going and sophisticated investors jumping in right now. So as much as a lot of people are in the consensus that the long-term investing makes sense, the main thing where people are asking questions about Airbnb and short-term letting is because their cash flows may be affected in the short term. So a quick summary on what short-term letting is, for those that don't know. So short-term letting is where you're renting out your property. You may have heard things like Airbnb for 1 night, 2 night, 1 week in terms of rent. So what some of the benefits are by doing that, and of course you need to look at it area to area, is you're generally going to get a much higher rent, less wear and tear, and that's interesting. And that's because each time someone's coming through, it's getting cleaned and maintained every single time. So therefore, the property is usually kept at an immaculate standard. Good flexibility, meaning that if it's in some locations, you can actually choose when you don't want to rent it out. And if you're buying in certain places in the country, you may be able to go there and stay there as a holiday for a period of time as well, if that kind of works as part of the strategy. And then also the tax benefits that come with that. I'm just going to touch on it now, but there are a few other expenses that come with doing short-term letting, but then there's a tax benefit attached to that too. So the considerations we want to be talking about, as I just said, is number one, location. In some locations, this strategy may not be viable and may not be a stable investment. As a general rule of thumb, not always the case. You want to be sticking to city fringe areas, inner city, 10Ks within there, or good coastal suburbs do really well as well. But the other thing you do want to consider is there's a higher cost involved in managing it. So higher fees to manage, maintenance of certain things may need to get replaced, outgoings you would need to pay, not the tenant. So things like electricity, water, which a tenant may usually pay, and you need to furnish the place as well. Once again, the good news is all of these expenses are tax deductible, so the impact isn't as much as you may think. So what I'll touch on now is some of the key data points that you want to be using to evaluate if that area that you've already got a property in or that you want to be investing is suitable for this strategy. So there's various bits of software and data you can use to find this information out there. So the first data point you're going to be looking at is what's the average daily rate. I'm using two suburbs that we're investing in at the moment as high growth areas, but where the Airbnb strategy would potentially also work. So I'm using Medora Bay, which is on the south coast of Perth, outer suburbs on the coast, but still proximity to travel to the CBD. And we've got North Melbourne, which is 2 kilometers outside of Melbourne CBD. So you've got the average daily rate of what someone's paying in those areas, and then you've also got the occupancy rate. So how often that property is occupied. So this one, 65% of the time there's someone in there, and 35% of the time there's not. And for the North Melbourne, 60 and 40. What I do want to say when looking at this data, it's important to dive deeper and look at the specific type of asset you've got in that area, because the average can get skewed quite heavily if there's a lot of, say, one-bedders or studios in that area, which will drag this number down. And on the flip side, if you've got a lot of houses and you're buying a unit, then it's going to flip as well. So that average daily rate isn't the number is a good starting point to look at, but you want to dive into the particular asset type that you have. And depending on the type of investment, with the type of investments that I guess we tend to focus on, the higher quality assets. So once again, the occupancy rates may be slightly better than that, but once again, good to be conservative in any calculations that you are doing. So as I was touching on before, asset types, you can see here, there's another data point which shows the preference of the type of property that someone would want in that area. So this specifically talks about holiday rentals and what type of properties are being rented out. So you can see here in Medora Bay, the majority are 3 and 4 bedroom houses, which are being rented out. And you can see here in North Melbourne, the majority are 1 and 2 bedroom apartments usually. So once again, not that this should be the dictator of what type of asset you buy, it's probably a strong indicator, but there's other things you want to consider as well. But purely looking at it from this lens, you can see the different types of assets in different locations that will likely get a stronger benefit in that area. So now I want to show you what I was saying before about diving a little bit deeper in terms of how much you're likely to get for the holiday rental. So in the area that we're focusing on, Medora Bay, we're focusing on 4 bedroom houses, proximity to the coast, and yeah, brand new assets which are more desirable, easy to rent, etc. When comparing like for like in terms of the type of properties that we're looking at, you can see the daily rate for something like this is you have 424, 463. In a cash flow I'm going to show you later, I'm going to use 400 just to be a little bit more conservative than these numbers. But depending on how you like to do your numbers, you might want to look at it higher, lower, but I will be using 400. In the North Melbourne example here, we are focusing predominantly on 2 bedroom, 2 bathroom assets. Got a couple of 2 bedroom examples here. You can see the daily rate in North Melbourne, 380 and 334. Once again, to be conservative in the calculation I'm going to do next, I'm going to use 300 as the example for the daily rate. So here's a very simple comparison when it comes to comparing short-term I'll use my smaller head here. When it comes to long-term and short-term letting. So looking at this top line here, Medora Bay, rough purchase price average about 580,000 for a 4-bedroom house. If you rent it long-term, you're looking at about 600 per week. The vacancy rates in the area are 0.3, so going to be occupied 99.5% of the time. And that would mean you're getting a rental income of around 31,000 a year. The fees, call it 8% rental management fees in the area. So the gross annual income is going to be $31,044. And so a gross yield of 5.35%. Rental fees, roughly 8% for traditional long-term letting. So the net annual income after that is going to be 28,560. So your yield, you're looking at net yield. So the gross annual income is going to be $31,044 or a 5.35% yield. Fees roughly 8%. So that's going to be a net annual income after that of 28,560 or 4.92%. You can see here in Medora Bay, if you did the short-term letting, call it, so that's I'm doing it at $400 a day with a 65% occupancy rate, then the gross annual income is going to be $94,000. The fees in total, you're looking at about 30%. You've got to pay, for example, Airbnb, the fees to host on their website. Then you also got to pay like the property manager as well, which is a bit more expensive because of the the amount of work that needs to be done as well. So fees are about 30% there. So you're looking at a gross yield of 16.32 and a net yield of 11.42. So you can see a pretty strong reason of why you may want to consider it in a location like that, and would be positive cash flow as well. And then you've got here in North Melbourne, similar story, but not as much of a big difference, but still worthwhile enough to consider doing. So once again, 680k purchase price, rent per week, call it $600. So 5.3% gross and a net yield of 4.16, which in its own right is quite strong. But if you did the short-term letting approach, you're looking at a gross yield of 10.36 and a net yield of 6.74. And although the jump doesn't seem as much, when you look at the difference here of net annual income, that works out to be roughly 12 plus 5, about $17,000 difference annually, which is no small number as well. So once again, something worth considering. So here you have like the full cash flow broken down. Once again, I won't take you through the whole thing line by line, because I guess I want to keep it more conceptual for the sake of this video. Of course, if you have more questions, feel free to reach out. But yeah, got the purchase price. I've used 20% deposit in both of these scenarios just to keep it consistent. Of course, your individual scenario may be different. I've put in the rental figures with the vacancy rates we discussed. So we've got in here 300 a week with the 40% vacancy, and we've got here 400 a week with the 35% vacancy. Once again, quite conservative, depending on these particular assets that I'm talking about. And then I factored in all the rental expenses and everything into the calculations as well. So in this situation, I'm using a 5% interest only rate. And I have put in an extra $15,000 in here, which is going to be upfront costs that you may need to furnish the place as well. And once you kind of put all that in there and you can see the income plus the tax benefits that are there, you can see that the one in Melbourne, you're likely to positively cash flow about $230 a week and increasing from there. And the one in Medora Bay, you're looking at a whopping $540 a week and then increasing from there year on year as well. This is a great way to, I guess, think about your strategy and think where it may be suitable for a property that you already have or an investment that you want to make. You can get into some good high growth locations that are going to benefit long term whilst not making an impact out of your back pocket whilst you're holding onto the asset as well. As always, if you have any questions, feel free to drop them in the comments below or feel free to reach out to the team directly. All right, see you in the next one.